Bob, I've heard the term flip tax before in a real estate transaction. What is it, and who is impacted by it?
Well, Jason, the person that's impacted by it is generally the seller, and probably the concept of a flip tax came in the 1980s when co-ops became hot, and people were able to buy co-op as they were just being developed. People were just able to buy co-ops at lower prices than be able to sell them for higher prices. And I guess the people in the co-op were thinking, hey, there's a lot of money. People are making money off of these sales, these flips. They buy it maybe for 100,000, sell it for 175,000. So someone probably came up with the bright idea, hey, let's tax some of these people. Internal tax. This is not a tax by the state or the city or the feds. This is an internal tax, what they call a tax. Could just be called a charge. Uh, where some of the money that the difference between the sale, the purchase, and the sale price, some sort of fee is imposed upon that, so that some of the gain that the individual investor is making goes back to the co-op, so the co-op can replenish, their treasury. Uh, the term has remained, although people aren't making that much money in flips nowadays in co-ops. The prices of co-ops are pretty steady. They have to be approved by the co-op. They have to be within a certain range, and the idea of flipping is just not a concept that you see in co-ops. However, the tax or the charge remains. Some co-ops may say, look, Mr. Seller, we enjoyed having you here. You did make a few dollars while you were here. You're leaving. We want you to leave some of your money behind. And maybe the tax is made up of just a fixed charge that the board decides to charge, maybe $2,500 for each sale. And that's how the co-op, put some money into its treasury in the 2000s and 2010s, 2016s by having a flip tax. So it's a mechanism to charge the seller a couple dollars on the way out. That money goes into the co-op and helps the balance sheet of the co-op look a little stronger.